It's Friday, 28th of June, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, a preview of the UK general election and how worried should we be about resurgent shipping rates. But first, Neil Shearing, Group Chief Economist, is with me to sift through the week in macro and markets and look ahead to the coming 5 trading days. Hi, Neil. How's it going?
Hi, David. All well, and you?
Good, thank you. Despite having watched at least some of that debate yesterday, we've got to start with the election and that painful Biden-Trump head-to-head. I want to say that it feels like more of a political story than a macro one, doesn't it? I mean, I note that markets are up a bit today as we're recording sort of early afternoon London time, so no discernible worry there. Depending on which polls you're looking at, Trump was looking like the favourite going into the debate, and I guess it's even more the case if Biden remains the Democratic candidate for this November's vote. But we've got fresh doubt now, don't we, that Biden may not be on the ticket come November. I mean, are there any economic implications around this uncertainty?
Well, if you look at the markets, what's happening in the markets, the answer seems to be probably not. As you say, bond market's up a bit today, yields down, but that's principally on the back of good PCE data, which I'm sure we'll come on to talking about. So, markets shrugging their shoulders at the moment. That's partly, I think, though, because these events are extremely difficult for markets to price. And that's inherent to their nature because elections provide binary outcomes. Either Trump wins or he loses, or Biden wins or he loses, or Biden's replaced on the ticket or he's not. And what markets therefore giving you is a kind of weighted average of the different probabilities of outcomes here. And as you say, before the debate, Trump was marginally ahead. The chances of a Trump presidency have increased a bit further, I think, following the debate. But there's clearly a whole range of different outcomes here. On the one hand, you could get Biden replaced on the ticket, but Biden could stay and Trump could still win. Biden could still win. The Democratic challenger could beat Trump. And then you've got the makeup of Congress. And then you've got to think about, well, if Trump is elected, or Biden's elected for that matter, what policies might they pursue and over what time? And within that, there are a set of circumstances that would be troubling for the economy, and we can get into what those might be. But the point is that markets are trying to attach probabilities to each of these different outcomes and scenarios. It's really difficult to do. And I think that's why we've probably not seen a big move in markets so far.
The team has spent months assessing the implications of Trump's possible re-election, though. I mean, talk through some of the key takeaways in terms of what awaits the global economy, global markets, if he's sworn in come January, as betting markets today are suggesting will happen.
Well, a couple of points are worth stressing, I think. The first is, going back to what I was just saying, there's still a great deal of uncertainty about the type of administration we might get and the policies they might pursue and with what priority and over what time frames. That's the first point. The second point is that although we learned during the first Trump administration that the extent of executive authority in the US is perhaps greater than what we might have thought. There's lots of ways the president can either circumvent Congress and push through legislative changes through executive actions. Actually, Congress still matters. The makeup of Congress still matters, particularly when it comes to fiscal decisions. So the makeup of Congress is important too. So we don't know quite what Trump administration we might get and what the policy priorities might be, and we don't know what the makeup of Congress might be either. That's a critical component in all of this. Now, with all that being said, if you take a step back and you look at the types of policies that are being proposed, there's one common thread running through this, which is that under a Trump administration, I suspect inflation might be a bigger problem. Why is that? Well, tariffs are inflationary. If we get a Republican Congress and a Republican president and Trump in the White House, then it's perhaps a bit more likely that they pursue tax cuts that are perhaps unfunded. That means a bigger deficit, that's stronger demand, and that's inflationary. And then finally, some of the immigration reform that Trump has talked about would have potentially substantial implications for the labour market and labour supply, insofar as it's not just dramatically reducing the flow of immigration, but also potentially removing undocumented workers too, of which there appear to be several million. That would have a big hit to labour supply. That would be inflationary too. So all of those three things, tariffs, potential for fiscal expansion and tax cuts, and in particular some of the immigration reforms, feel inflationary. They have more than the whiff of inflation about them. So very difficult to know the outcomes and very difficult to say anything with firm certainty. But take a step back, and our sense is that Trump presidency is likely to be one of slightly higher inflation compared to the Biden presidency or indeed any other Democrat president.
On to more prosaic issues. You did mention that PCE data. It used to be that inflation and central banks dominated discussion on this podcast. So I guess it just shows the uncertainty that all these elections are having, that's no longer the case. But we have just had some new PCE inflation numbers. What do they tell us about the disinflation narrative? Does that still hold? What do you think the Fed is going to make of this report?
Well, this underpins the moves in markets that we've seen today, as I was saying before, and it's good news. So we have the core PCE deflator, which is the Fed's preferred measure of inflation, increased by only 0.08% month on month in May, so 0.1% if you're rounding, which was enough when you couple it with revisions to some of the previous data, was enough to pull the annual rate of core inflation on this measure down from 2.8% to 2.6%. 2.57% to be precise, if you're being pedantic and looking at these things to two decimal places. And the breakdown of the core PCE numbers was pretty encouraging too. So lots here for the Fed to like, I think. The only whiff of concern, I think, is that there's further evidence in this report that consumer spending might be softening a bit more than the Fed and others had anticipated. In particular, spending on discretionary services appears to be faltering. So, more evidence that consumer spending is weakening. We're now down to 1.6% Q-on-Q annualized in the second quarter in our forecast. We've just updated our new GDP nowcast for the US, which is now tracking at 1.8% Q-on-Q annualized for Q2. So, still consistent with a soft landing, but substantially weaker rates of expansion in the real economy than we were used to in the second half of last year. And consumers at the heart of that. But flip side, for the Fed, much better news on inflation.
So, you've always said that there was a narrow path to a soft landing. It does sound like we're still on track for that. But what about the risks? We've had reports over the last few weeks of defaults in commercial real estate in the US. Given what's been happening with valuations in that market, given financial system exposure to commercial real estate, is this something we should be worrying about?
Yes, the key thing here is that we've seen losses on AAA-rated commercial mortgage-backed securities now in the US, and then this week we had news of losses on AAA-rated CMBS in Europe. So, point being, these are top-rated instruments that they should not be experiencing losses. Now, on the face of it, that's consistent with our view that we're going to see further distress in certain pockets of the commercial property market over the course of this year. But the point I would emphasize is that there's pockets of weakness and distress in commercial property rather than widespread distress. So in the US, it was that the CMBS in question was related to an office building. In Europe, it's related to UK shopping centres and German apartments. They're all parts of the commercial real estate market that we had anticipated would struggle and where we would see losses come through. I think it's also worth saying that there's been some valid criticism over the actual ratings of these bonds and whether they justified their AAA credit rating. So it's pockets of distress rather than widespread distress. We've published a note over the past week arguing that these pockets of distress in these parts of the market will continue to develop, but it's not creating systemic risks in either the commercial property market or, that, for that matter, in the financial system, the wider financial system. The losses in question are not big in the context of the global financial system. And like I say, it's contained to one or two sectors.
Finally, I'd like to ask about AI, because we've seen some notable selling of companies linked to this technology in recent days, not least NVIDIA. Some people are saying that this technology's benefits have been overhyped, that actually this is all a lot of hype, it's a big market bubble, that it won't be an economic game changer. What's your view on all this?
Well, I think actually this is a rare instance when it's actually helpful to separate the macro from the market. So one of the key conclusions from our Spotlight report 2023, where we delved into the economic and market consequences of AI, was that AI would be, in our view, transformative to productivity growth in certain countries, particularly the US, but that it would take a while for those benefits to come through. So principally towards the back end of this decade and the start of the 2030s. However, when you look at the history of breakthrough technologies, there's a tendency for markets to try and capture the perceived benefits of those technologies ahead of them crystallizing in the real economy. In other words, they become fervent territory for bubbles. And our view was that that's exactly what was likely to play out around AI. And indeed, I think that's what we have seen. There's genuine earnings growth in many of these companies, but if you look at the expansion of earnings multiples too, it has been substantial. So there's clear evidence of froth in technology stocks, pumped up by enthusiasm around AI, and some of that froth has come out. Now, if we look at what happens next on the markets front, if you look to the dot-com boom and bubble as an example, then I think there's still scope for price earnings multiples to increase further in some of these technology stocks. And indeed, that's what's embedded in our forecast and why we see the S&P 500 blasting through 6,000 over the next year. However, these are essentially bubble conditions and the bubble will eventually burst. The key point, though, is once the bubble in the equity market bursts, it's not going to take the technology with it. And eventually, we do think that the benefits of that technology will start to become evident in the real economy. It's just we're not there yet.
Neil Shearing there, our Group Chief Economist. We've got a large and growing body of analysis about the US election on our website, a lot around the risks of Donald Trump's re-election, but we're obviously continuing to follow the situation closely. Expect more analysis and briefings as we move towards November's vote, but do get in touch in the meantime if you have any specific questions about the macro and market risks around this election, and someone from the Economist team will assist. On that US data, Neil mentioned our GDP Nowcast. These are updated weekly and provide a real-time view of the US economy based on high-frequency data. I'll add a link to the relevant dashboard in the podcast notes. I'll also add that note Neil mentioned about those CMBS defaults by Matt Poynton from our commercial real estate team. Provides important context of what's going on in that market. There are drop-ins, those are our short-form online briefings on Monday, that's July 1st, all about our latest global economic outlook. The team will be briefing on what's happening with growth, inflation and monetary policy, but obviously political uncertainty will be top of the agenda. So do tune in for those and get your questions answered. There are sessions at 9 a.m. London, 4 p.m. Singapore, and then 3 p.m. London, 10 a.m. New York. Staying on election uncertainty, the first round of voting in France's snap legislative election will be out just as this podcast is being published on Sunday evening. Our take on those first round results will be in client inboxes that evening. And watch out for more coverage in the run-up to the final round next weekend, and join our drop-in on Monday the 8th of July, so that's the morning after the final round of voting, for our assessment of what's happened, our key analysis on what this election means for the outlook for French bonds, for equities, for the euro, and for ECB policy is all on a dedicated page on our website. I'll add that to the podcast notes along with the drop-in registration. But France isn't July's only big vote. The UK general election is this coming Thursday the 4th, and if the polls are right, then Labour is set to trounce the Conservatives and become the ruling party before the weekend. If that doesn't happen, it'll be the biggest upset in modern British politics, and the pollsters can question their career choices. But what will a Labour government bring? How long before investors find out about Labour's tax and spending plans? And why are relatively calm UK markets presenting such a study in contrast to their French peers? Paul Dales, our Chief UK Economist, got into all of this with Deputy Chief UK Economist Ruth Gregory a couple of days ago, and here's that discussion now. You'll hear Ruth first on that last question about the relative calm of UK financial markets.
Yeah, I think maybe there's perhaps two factors that explain this. The first is that the UK election has always looked pretty clear, hasn't it, while it's very uncertain in France. And the second factor is that the election manifestos released by the Conservatives and the Labour Party suggest that neither are really planning on significantly deviating from current plans for fiscal policy to be gradually tightened over the next 5 years. So I suppose in one sense the UK's already had its Liz Truss moment, and both the Conservatives and Labour do appear to have learnt from it. By comparison, I suppose the parties that may be in power in France are openly planning to loosen fiscal policy by more. So it's I think it's perhaps not too surprising the financial markets are a bit more nervous about the situation in France, and that perhaps explains why in recent weeks French government bond yields have risen relative to yields elsewhere, the euro's weakened, and French equities have fallen.
Yeah, it's still a long way away yet by comparison, but the US election is not that far away, and the debate hasn't really got going yet. But it doesn't look as though either the presidential candidates are going to be campaigning on a platform of reducing their even bigger budget deficit. And as we all know, there's a case for quite a lot of uncertainty after that US election. So we might be entering a very strange period where the UK emerges as a bit of a beacon of fiscal and political stability. I mean, that would be quite something. I guess part of that is because we don't think Labour's going to do too much when it comes to fiscal policy because it's bound by the same fiscal rules as the current government. And that's why we're not going to really be ripping up our economic forecasts should there be a new Labour government after the election. There are, though, some question marks over taxes and spending. That's been the case during the election campaign when it comes to Labour's policies. When do you think we might get some answers on this? For example, when's the earliest that there could be a budget by a Labour government?
Yeah, I suppose the first thing that will take place is the King's Speech, which is on the 17th of July, and that's the opportunity for the next government to outline its priorities. But it's not until the next fiscal event that the government will actually unveil its tax and spending changes. There's probably nothing to stop the next government from holding an emergency budget immediately after the election. But if it wants to have a full set of economic and fiscal forecasts from the OBR alongside that fiscal event, then the government has to provide the OBR with 10 weeks' notice. And the Shadow Chancellor, Rachel Reeves, has said that Labour would ensure that any future tax and spending changes are subject to an independent forecast by the OBR. So I think if Labour were to win the election, as the polls suggest, then the earliest the fiscal event could be held is probably around the 13th of September.
Yeah, I mean, it would be very odd for Labour to say they're learning from the Liz Truss event and then to do exactly a Liz Truss and undermine the fiscal situation by not letting the OBR do its job properly. So mid-September then could be when we start getting some of those answers. And if there were a budget around then, what kind of fiscal flexibility, or in the jargon, fiscal headroom, do you think the OBR might grant the next government?
Yeah, I think based on the latest economic developments, and if we assume that the OBR's medium-term projections are broadly unchanged, then our version of the OBR's model suggests that if the OBR updated its forecast right now, the next government may have a little bit more fiscal headroom or fiscal space at its disposal to cut taxes and or raise spending. Perhaps it might have about a headroom of about 16 billion, which would be up from the 9 billion that was left over after the March budget. It's worth saying, though, that those estimates are hugely sensitive to the OBR's economic forecasts and the market pricing for the future path of interest rates. So if we were to run those numbers based on the less upbeat consensus forecast for GDP growth, then the existing headroom could be wiped out and the next government would need to raise around 13 billion just to meet its fiscal rules. And by contrast, if we use our own forecast, the interest rates will be cut further than investors expect, and tax revenues will be a bit higher than the OBR predicts because of higher house prices and higher equity prices, then that headroom could be a bit bigger still, perhaps around 27 billion.
Can you put some of those numbers in context? So let's take the 16 billion then, which might be what happens based on our current estimates, what the OBR might do. How does that sort of relate to some of the unanswered questions, perhaps to do with either taxes or spending that came up during the campaign?
Yeah, I think 16 billion does sound like quite a lot, doesn't it? But as you say, there are those big questions that have been left unanswered on the campaign trail. I think the first and the big one is the current plans to cut departmental spending for unprotected areas. So that's areas outside of the NHS, education, defence. So those cuts will happen in real terms from 2025-26 on current plans. And the second question is whether the next government will continue to cut public investment in real terms from 2024-5 onwards, and also whether the planned freeze in personal tax thresholds go ahead. So that headroom of 16 billion, it would allow the next government to reverse some of that scheduled spending restraint or unfreeze those personal tax thresholds, but it wouldn't allow the next government to do both. It's worth saying, though, that much does depend on the economic developments between now and the next fiscal event and the OBR's forecast, perhaps as well as the willingness of the next government to raise taxes and fund extra spending that isn't sort of covered by that headroom estimate.
A lot of variables there change things, but perhaps the message is that things might be a little bit better for the next fiscal event than perhaps at the last one. And when it comes to spending, I mean, we know a budget sets overall levels for public spending and overall levels for taxation, and usually details on taxation as well. But we don't really have any details on department spending beyond the current financial year. When or how are Labour going to sort that out?
Yeah, I guess there's probably two scenarios here, isn't there? The first is, as you say, Labour knows that there's a spending cliff coming in March 2025, insofar as governments don't yet know how much they'll have to spend from April 2025 onwards. And that there is that tricky decision to make on the path of public spending. But it perhaps kicks most of the tricky decisions down the road by allocating departmental and capital spending for just 1 year in a spending review in the autumn. So that would mean that it essentially sticks to the existing plans for overall spending, which, as we've already spoken a bit about, they are consistent with a very big real-term cut in spending for unprotected departments, equivalent to around 75% of the cuts that were made during the austerity years of 2010 to 2015. And I suppose the second scenario is that a Labour government concludes that those current plans for public spending and capital spending are just too low, and it puts in place in the autumn, in a spending review, higher plans that are allocated to all the different departments in full over the next 5 years. I think as things stand, though, if Labour wants to stick to its fiscal rules, that would probably require a much more optimistic set of medium-term economic growth forecasts from the OBR, or taxes might need to rise to fund those increases in spending. So I think perhaps for what it's worth, our hunch is that of those two scenarios, the first is a little bit more likely. If anything, perhaps the Labour government will wait to see whether that sort of push, to put the broader push to reinvigorate economic growth through things like planning reform, succeeds before it makes any big changes to tax and spending.
That was Ruth Gregory talking to Paul Dales. Paul and Ruth will be online this coming Friday at 9:30 UK time, 4:30 Singapore, to talk about the election results and take your questions. So sign up for that briefing. If the timing doesn't fit your schedule, as with all our drop-ins, sign up anyway and you'll get a link to the recording in your inbox as soon as the session is concluded. Finally this week, shipping costs are back in the headlines after they recently began surging again. What's driving their resurgence and how worried should we be? We've got an interactive dashboard tracking global shipping costs on the website, and CE Advanced clients can download the underlying data to plug directly into their workflows. Simon MacAdam, who leads our coverage of global shipping costs, has just refreshed that dashboard. And he spoke to Leah Fahy from our China team about why these costs are in the headlines again. Conversation starts with Simon discussing how freight rates have performed in recent weeks.
So we've seen an 87% increase in the global spot freight rates in the most commonly tracked measure of global shipping costs since the beginning of May. So this is a very big move. It's driven almost entirely by outbound routes from China. So we've seen freight rates on those routes double, or even slightly more than double in the case of routes to the US. Total shipping costs, so not just the spot rates, but also including all the contractual freight agreements as well, they're up by a much smaller amount, maybe more about 50% on outbound routes from China. But the big picture is that even though these sound like big moves, they are, of course, significant. But just to put them into context of what we've experienced in the past few years, is that in 2020 to 2021, we saw 900% increases in freight rates on outbound routes from China, and sort of more like 300% increases in total shipping cost increases. So these recent moves are big, particularly because they came on the back of already elevated shipping costs. Because remember, of course, we had the Red Sea disruptions earlier in the year. So shipping costs were already high, and now they've risen still further. So they're high, but in the grand scheme of things, we're about a third of the way to the peak that we saw in 2021.
Right, so not quite COVID levels yet. So I guess when we think about what drives increases in shipping costs, it's about the interaction between supply constraints and strong demand. So, for example, I guess in COVID-19, there was a surge in demand for goods over services brought on by lockdowns, as well as worker shortages that drove up shipping costs to those eye-watering levels you just mentioned. This time around, is it a surge in demand for Chinese goods, or is it more of a supply side problem? Could you just talk us through, I guess, what's been playing the biggest role?
Yeah, it's an interesting one. On the face of it, it's a little bit of a mystery if you look at some of the key macroeconomic indicators. So if you look at things like what is container throughput through the world's largest ports, including those of China, they haven't done anything particularly remarkable. I mean, at the global level, the volume of containers going through ports has ticked up a little bit, but it hasn't. We haven't seen any surge. And in fact, in China, as you'll be aware, we've seen actually a bit of a drop-off in container throughput more recently. If we look at the manufacturing surveys for export orders, again, we haven't really seen anything of a surge. In fact, at the global level, export orders have basically been flatlining in recent months. There's no been actual growth in export demand, as it were. Whether we look at maybe there's a problem with the ports in terms of congestion. You know, we saw very congested ports in the early 2020s and in the pandemic period that helped and contributed to higher freight rates. We're not seeing that either. Congestion's very low. So on the face of it, it was a bit of a mystery what on earth's going on here. But I think there are a few things. So first things first is that even though the aggregate trade volume around the world may not be rising particularly strongly right now, I think there's an interesting change in the pattern of world trade. And this was something we saw in 2020 as well. Remember when countries went into lockdown, there was a huge shift in demand for goods to be exported from China, namely PPE equipment, working from home equipment, and so on. That was the theme that was going on back then. I think more recently, we've seen a similar sort of shift. So China is gaining market share in terms of global exports on the back of quite heavy price discounting linked to its broader macroeconomic scenario in terms of overcapacity in its manufacturing sector. So we've got that going on. We've got a shift in the pattern of world trade, which means that shipping routes have to change with that, and the containers to be able to transport goods have to be in the right place at the right time. So if you have sudden shifts in the pattern of trade, that can cause disruptions. So I think that's part of the story here. But also, I think that it's become absolutely patently obvious that the Suez Canal is going to be a no-go area for container ships for the rest of the year. I think that's dawned on importers, and consequently, people are putting in unseasonably high orders for deliveries that would ordinarily come later in the year. They want to make sure that they get their festive orders on time, so they're getting in the orders early, which is causing a boost in demand for containers that just don't exist. So that's pushing up freight rates, I think.
So I guess when it comes to thinking about shipping costs, one of the biggest concerns that people tend to have is the impact that that's going to have on inflation. And kind of alongside that, it sounds like there's a lot of uncertainty, but do we have any sort of gauge on how long these increases are going to last, how high freight rates will go, and then as a result, what the impact is going to be on inflation? Yeah, I mean,
first of all, we're not shipping analysts, so we don't actually forecast freight rates ourselves. But I think there are a couple of things that we can say. And one of those is that it is quite clear that shipping supply is constrained and will continue to be constrained in the year to come, which is interesting because we're actually seeing record deliveries of new ships that were ordered a couple of years ago in the pandemic. They're coming online. April saw the biggest level ever of new container capacity coming online. But DHL, the logistics company, they recently estimated that about half of that new capacity coming online has been eaten up entirely by just the longer journey times around the Cape of Good Hope. Because of the movement of trade away from the Suez Canal, that's eating into effective global capacity. So once you also introduce things like scrappage of old ships and a bit of congestion here and there, supply isn't really growing very much at all this year. At the same time as global demand will be increasing to some extent. So that is a sort of if you think about the balance of supply and demand, that doesn't point to particularly much lower freight rates than where we are, and potentially higher ones. So I think that we could see a further increase in freight rates, and hence people start being concerned quite reasonably about the inflationary risks associated with that. The simple point we've made in the past is that if we think about the total value of global consumption that can be attributed to the cost of shipping goods, it's about 0.4%. 0.4%. So that's to say, if global shipping costs doubled, and there was a pass-through, a 50% pass-through. Some of the costs were absorbed along the supply chain, but half of it made through to the end consumer. That would increase the global price level by 0.2%. Now, we've actually seen far smaller increases in shipping costs this year than that. So we're probably at the level of only adding about 0.1% to the price level for consumer goods and services generally. So we're talking about a margin of error in terms of forecasting inflation. We'd have to see the sort of increases we saw during the pandemic, that is to say, another twofold increase in freight rates from where we are now, before we're getting to the sort of 0.3, 0.4, 0.5 percentage points that you're potentially adding to inflation. And at that point, you really have to start incorporating that into your inflation forecasts, because it becomes something that is moving the needle.
Simon MacAdam, our Deputy Chief Global Economist, talking to Leah Fahy from our China team about the spike in global shipping rates. I will link to Simon's latest analysis and to the dashboard. It's one of several newly enhanced dashboards that we have on site, covering everything from EM risk to the green transition to the China macro story. Again, CE Advance gets you access to all the dashboards and their underlying data. Learn more at capitaleconomics.com/advance. But that's it for this week. Until next time. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.